Hello traders, and welcome to another trading webinar. Today the topic of our meeting is, of course, the correct trading process. I will base my today's speech on the late great trader, investor and coach Mark Douglas, who is the inventor and of this concept, the correct trading process. Of course, I need to show you the disclaimer at the beginning of our presentation, because this is the right thing to do at every presentation regarding the financial markets. And of course, we might start with a quote. The best traders think in a number of unique ways. They have acquired a mental structure that allows them to trade without fear and at the same time keeps them from becoming reckless and committing fears-based errors. So please be very, very aware of this fact. This is one of the best quotes regarding the trading I ever heard in my trading career. So what's the agenda of today's meeting? The correct trading process, as I said, is a webinar inspired by Mark Douglas, and we are going to speak about trading edge of in trading and how to get it, about the odds in trading and the signals, and if we should trade the signals or not. Of course, we will take a great part of this meeting talking about money management and accepting the risk level. All of this parts, all of this partial blocks are actually very well connected with the correct trading process. So let's start. Let's start by explaining what is the correct trading process. As you can see, it has a 5 points. Point 1, get trading edge. If you don't know what it is, then you don't have any. Very, very simple. You need to trade using trading edge. Second point, odds must be in your favor, which means that your technique, your trading strategy, your trading plan, however you call it, must have more than 51% of expectancy. That means it cannot be 50%, because this is a random behavior of your trading system. Sometimes you make money, sometimes you don't, but this is all connected with the randomness. Which is of course more like a casino style of trading, and it's not correctly connected to the trading process, because the odds of that you make the money are 50-50. So the odds are not in your favor. You must have an advantage, which is apparently a part of the trading edge. The third thing is that you need to trade every signal, because you don't know which one will be the profitable one, right? This is very, very important. Of course, you need to trade every time your system, your scenario, your analysis, whatever you use, is showing you that this is the trading setup with a signal that you should take. And you should take every single one, despite the fact whether you like it or not. Okay, so that's the very important thing. The next one is you need to identify risk, which is how much money you are willing to risk to find out if other traders will trade according to your position. Which means if you are long, if you define the risk as 2.2 to 1, which means that you will get 200%, every 100% you will basically risk. That means if the market will go $2, right, you will risk only $1 per this move, or 3 to 1, which is if the market goes 3%, you will risk for this actual single trade 1% only. 1%, I'm talking about 1% of your account, or about the 1% of your daily stop loss amount. It doesn't matter how much you will define it, because it's up to you, definitely, to find out how much you need to risk, okay? To find out if the other traders, which means markets, are trading in your favor, in line with your position. If you're short, you want market to be short as well. If you're long, you want market to be long as well, okay? And the last thing, you need to plan money management in order to obtain a stable and consistent profit. So again, without money management plan, you will not be able to do so, and this is the correct trading process. It gets with all of this 5 points. If you don't have one of them, that means you are not trading in a corrective manner. That's the Mark Douglas thing. That's the Mark Douglas input inside of the trading community. So we start with the first one, which is a trading edge. Of course, I've been talking about it before, but I will gladly repeat the very crucial part of the correct trading process. Trading edge, what is it? Trading edge is as Mark Douglas says, one of the first things you need to learn as a trader is how to put out the odds of success in your favor. In other words, you need a high probability trading edge. But remember, a trading edge is simply a higher probability of one thing happening over another, over a series of trades. It's not a guarantee you will make money in the markets. You need to combine that trading edge with the proper mental skills. So this is actually a set of conditions that, if they are present, the trader are more likely, is more likely to be successful than to fail. I mean, to profit than loss. And it's composed with 3 different areas. With the strategy, it doesn't matter if this is a fundamental strategy, if this is technical strategy, if this is statistical strategy, it doesn't matter which one of this. It's up to you which one you're gonna follow. Is of course money management and all of the things related to the money management, and trading psychology, right? And in the middle of these 3 circles, in the middle of these 3 areas, this is a trading edge, right? This is, I think, kind of a simple thing to be aware of. Mark Douglas, he very often speak and writes about the mental aspects of the trading, then about the strategy. When you combine, like Mark Douglas' mental trading principles with a high probability trading strategy, you will be armed with a solid trading arsenal and ready to walk out onto the battlefield. I mean, the markets, and execute trades consistently like a professional, successful trader. Of course, you need the time to get all of this to happen to you, right? So this is how it looks like with the trading edge. I think this is pretty much simple. Right now, the odds, why are they important? So please please notice that technical methods of any kind, price action included, are not designed to tell you what a market will do next in the future. They are designed to help trader put the odds of success in his favor over series of trades. There are some profound psychological implications that go along with that. The outcome of any particular signal is unique and random, and there is no way to know in advance the outcome of any particular signal or the sequences of wins and losses over a series of trades. And in other words, the nature of trading is random, right? But the Mark Douglas goes onto the description that includes something that might be a little difficult to understand at first, right? But it's critical for you to grasp if you want to make a consistent money making. So by accepting the random nature of trading, you can produce the consistent results. Now, it seems contradictory on the surface, to say that you can produce a consistent results from something that is random in nature. However, if we dig a little bit deeper, the technical markets and patterns will give a trader the same advantage as a casino has over any individual player. A casino has an edge for every game they offer. What a casino knows is that any singular instance of someone playing their game might result in a player winning the money or even hitting the jackpot due to the edge they hold. Over time and over enough series of events, the casino will make a profit, and a large one at that. Okay, so remembering this point will help you make the transition from thinking in certainties, as I say, to thinking in probabilities. This is what Mark Douglas describes, and as you should be really thinking, right? If you do not integrate the randomness principle, you will find trading is the most frustrating endeavor you can undertake. You can only generate consistent returns by understanding that each trade is random and unique, and then taking that information and using it to control yourself after each trade. Do not get hung up on your last trade. Instead, focus on consistently trading your method, your system, and develop your system over and over and over again, because frustration comes from expecting something your method can't do. The technical methods finds and identify patterns in collective human behavior, and the problem is the outcome don't always correspond with the pattern on a trade by trade basis, right? One by one. And there doesn't have to be a relationship with the outcome and the pattern. There is no guarantee that this trade will be the exact same. It will give you the exact same result as the last one, even if they look the same. And rather, the method only tells you that if we use it consistently, then over a series of trades, traders should be profitable. Okay, so this is why you should trade every signal, every single one. You should trade, because you never know which one of this single trade will be actually profitable by the terms of the risk you already accepted, right? You are entering the market in knowing that there is a probability that this trade will be a winning trade. It might be a losing trade, but there is no guarantee, right? That because you trade it over and over and over, this time it should be the same, right? Or maybe if you see any special pattern on the market, you might think that, oh no, this time it will be different. And when 100%, you can say with the 100% certainty that it won't be different this time. It most likely the market will sooner or later behave the way it used to behave in the past, but there is no guarantee that this trade will give you the exact same result, which is why you should take the opportunity every single time your system is giving you the signal. Okay, so think in probabilities, not in certainties, right? Perhaps this point about the market by Mark Douglas is most famous for drilling into traders, is that you need to learn to think in probabilities, right? Like almost like a scientific thinking. As I said before, it's critical to understand that there is a random distribution of wins and losses over any sequence of trades. And traders who learn to think into probabilities do not experience the mental bias like those traders who haven't learned to think in probabilities, because they are not expecting a winner on any given trade. Like those who don't think in probabilities, they just trade. They see the trading setup, they have a signal to trade, they accept the risk, money management, techniques are going in here, and then they push the button and trade. Learning to think in probabilities releases you expectations from trades, because you are focused on the results of the overall series of trades, not on the result of any given trade, any particular one. Okay, if you have a weighted coin that will be heads 70% of the time, you still don't know the sequence of heads and tails. All you know is over time 70% of the flips will be head. Okay, to execute trades without making mental errors, you have to be free of thinking that this trade will be definitely 100% a winner. The typical trader expects that this trade to be a winner, or why would they take it, right? This is how the typical trader thinks. But you can't think this way if you want to make consistent money. Once you start expecting each trade to win, you become emotionally attached to it. And when you should know by now, it's not any one trade that matters, but the overall series of trades, and your ability to remain disciplined that over that series of trades, that matters really, right? Not the result of any particular single trade. And the last thing, risk-taking strategy. A professional, successful trader doesn't think to himself, will this trade work? When a potential trade is present, when they have a setup and signal, because they understand the human component that makes it basically random, what he or she does think about is the risk. How far I'm willing to let this trade go against me before I see if other traders are going to come in and make me a winner. How much I'm willing to risk on this particular trade before the market will tell me I'm wrong or I'm right. In a winning trade, traders start focusing on the retracements and end up exiting at a low profit point rather than seeing that it will go back up. So you need to stop thinking about the outcome of the trade and instead think about risk and where you will exit, not about if the trade will be profitable, right? Mark Douglas also refers often to something he calls the profit gap. What he is talking about is basically the difference between the potential profit you should achieve where if you had just followed your trading method and what your actual bottom line results are. So that's the gap. The traders often begin trading in a method that they have a very high hopes and high expectations, right? They want to produce an income they can rely on and get consistent results from their trading, but they do not include in their plans the risk it takes to achieve it, okay? However, this is only possible if you are taking an effective method and discipline, consistency, and controlled risk, which most people simply do not do. And as a result, they experience the profit gap, okay? The key point about this profit gap is that traders typically try to fill the gap by learning more about the market, changing methods, spending more time, more screen time in the front of the computers and so on. However, what they really need to learn is more about themselves and how they interact with the markets. Essentially, they need to acquire the proper mental skills to trade their method as they should and to get the most of it in order to properly fill the profit gap. So what they should do is to follow this quote that I always present at the end of my webinars, which says one of the biggest hurdles you have to overcome as a trader is staying in the market long enough that you understand the market mechanism and that your psyche, your habitual and learned spontaneous reactions, they are no longer your enemy, right? So that's what it is all about. And this is why in the trading edge picture, as you remember, the biggest part responsible for your overall winning in the markets, in the fact that you will be successful trader or not, is, as a Mark Douglas said, proper mental skills, or as we can say in general, the psychology of trading. And if you will follow the correct speculation, correct trading, correct investing process on the financial market, then definitely you will experience a difference in your trading results. It might be even the way to actually cover the profit gap you might be experiencing right now as a beginner or not that much successful trader. Thank you very much for watching this webinar. I'm very glad that you have stayed with me during this little talk. If you are interested and you want to know more details about Mark Douglas, his trading methods and his approach to the trading and to the mental skills, please refer to the internet. There's plenty of resources free of charge on the internet. I think you should find something interesting to you. So thank you very much for watching this short webinar. And please don't forget about our partner, the Global BD Trading Company, which is, of course, professional trade room in Poland, in the city called Katowice. And if you would like to know more about the company, please use one of the way of a contact, as you can see right now on the screen. That's everything for me for now. Thank you very much for watching this webinar, and I hope we will meet soon again. Take care and bye-bye.